Elizabeth Harris with GRA, Guaranteed Rate Affinity. They're our partner brokers here at Coldwell Banker. And Libby's been kind enough to answer a few questions, so we're going to go into 3 different parts. And we're going to start with some basic questions first. So Libby, thank you for joining us. I was just hoping you can start off with, how can we find out how much they qualify for with a loan? What's the best way to go about that?
Super easy. First thing they want to do is contact a lender, ideally me at Guaranteed Rate Affinity. No, kidding. Contact whoever you want, but hopefully they're a good loan officer. At Guaranteed Rate Affinity, it's very easy. You just go to our website or click on the link in our email, apply now. If you're in front of a computer, it shouldn't take more than 10 to 15 minutes to complete.
Fast.
Yeah, to complete the online application. We get an alert when you start and finish the application. So again, about 10 to 15 minutes average. If you're trying to do it with 2 thumbs on a phone, it may take you a little bit longer, but it pulls your credit live right there on the spot. You get to see what your credit score is that we're looking at. And if the stars align, there's a new feature where, and I haven't seen it happen yet, but there's a new feature where you could get pre-approved on the spot and look at your letter right there.
Right there in the first 15 minutes. Yeah.
Right there, yeah.
Interesting.
So usually, if you don't get pre-approved on the spot, don't worry. Usually a loan officer or VP needs to pop in there, check a few boxes, maybe ask you a couple questions, but it shouldn't take too long to get you pre-approved.
Awesome. And when they're going through that process, is there any steps they should take before getting it pre-approved? Like, I don't really know what my credit is. I've not applied for a house before. Is there anything I should look at as a consumer before speaking to you as a loan officer?
You can. It's always a good idea to know where you stand credit-wise. There are all kinds of free credit monitoring services out there. Personally, this is not GRA recommending it, but personally, I use Credit Karma because they monitor. It's free monitoring for Equifax and TransUnion, and I use the free Experian app. And there are also services with the Experian app that can help with the home buying process, but I won't dive into those unless you want me to.
No, I think that's good right there. So kind of in that same light, though, while people are in the process of being pre-approved, applying for the mortgage maybe beforehand, like what are some things they should avoid doing?
Let's see. So if you know you want to buy a house, one of the worst things you can do is incur more debt because your debt to income ratio, which I think we may talk more about later.
Definitely.
But that's huge in the home buying process. That tells us how much house you can afford. And so if you go out and you buy a new car with a nice chunky car payment,
right?
And let's say you take out some credit cards because you want to start furniture shopping, I would highly recommend on waiting until after you move, so you only have to move that furniture once.
That's smart. A lot of people, I think, get on that furniture side. They get those consumer credit cards, and it sneaks up on them right there.
It's a slippery slope.
It definitely is. So kind of looking at the loans themselves, I've seen a little difference in like an advertised interest rate and then something called the APR. Can you describe the difference in those two?
Sure. The easiest way that I can explain that, and that I have the best way that I've explained it over the years, is your interest rate or note rate is the amount of interest that you're going to pay. That's how we calculate the interest that you're going to pay over the entire life of the loan. The APR is like taking all of that interest, lumping in closing cost or origination cost, and then spitting it back out in the form of a percentage. So the APR should ideally represent the true cost of the loan with interest included. And it's a way for buyers to compare apples to apples. So if one lender's offering you a 4.5% interest rate with a 4.78 APR, and another lender's offering you that same interest rate with a 5.02 APR, well, you know who's got the cheaper loan.
Gotcha, because they got a lot of hidden fees in there, and don't look just the interest rate, look at the APR there.
You got it.
Gotcha, okay, that makes sense then. And so kind of in that same light there, looking at people that are going to apply, they're looking at the interest rates. So if they have like bad credit, for instance, or have filed for bankruptcy or anything like that, can they still get a mortgage, or are they be paying more interest for that, or how does that all work?
Both.
Okay.
You can still get both and not quite both.
Okay.
So, can they still get a mortgage? Yes. The earliest time frame right now that I'm aware of to get a mortgage outside of bankruptcy is 2 years after the discharge date for a Chapter 7.
Gotcha. In terms of like the credit itself, if they have bad credit, like what is like a minimum score you really want to look at, and like how long does it take to improve it from there?
So that can vary from lender to lender.
Okay.
Our minimum credit score for certain types of government loans is a 580.
Wow.
And then we can go down to a 620 on conventional and one type of government loan as well. The lower your credit score, the higher your interest rate usually is.
Sure.
And sometimes you may even have to pay points just to be able to get the loan done. But yep, 580, 620, and those do change depending on the market.
But I would say, I think a lot of people, they think it needs to be a much higher score than they actually need in order to qualify for these. Now, obviously, like you said, you pay a little bit more, but sometimes it's better to be in a house than paying rent. That's going to be way more than a mortgage anyway, even if it's a slightly higher interest rate there.
That's right.
But so when people come to the table, like what kind of cash reserves or down payment should they have with them? How much should they be saving up for a house?
If they're buying a home that they plan to live in, what we call a primary residence, the minimum down payment we can get away with, in some cases for first-time home buyers, is 3%.
Okay.
3 to 5% on a conventional loan. For FHA, and we'll get into the different loan types later, I'm sure, 3.5%. But there are also some loans for eligible borrowers and in eligible areas where no down payment is required. You do still want to have some money for closing costs.
Right.
And that can vary widely depending on the purchase price.
Do you have like a ballpark for the closing costs? Is it a percentage usually, or is it closer to like a static dollar?
It can really vary widely depending on the loan scenario,
Sure.
credit score. If you have a higher credit score, we can help out with the closing costs, but I think we're going to get into that later also. I would say a good starting point, again, depending on the loan, like if you're getting 100% financing, you still want to have at least $5,000.
Okay.
That should cover some escrow reserves, your lender and title closing costs,
Gotcha.
recording fees, and all the fun things that go into closing costs.
Makes sense. So that 20% number that everybody knows, that's not really relevant anymore. Really closer to like 5% is probably what people want to factor in, like the 3
I
for
like
the
that.
Perfect.
Yeah.
That's good. I think a lot of people in their head, they have that a little bit off there. So it's good to know it's a little bit lower than people expect. And to kind of pivot just a teeny bit, looking at like my job here, what kind of job history do I need? And is there any specific jobs or anything that would not qualify for mortgages, if that makes sense?
So, sure, for traditional lending, and I think we'll talk a little later about non-traditional lending products.
Sure.
For traditional lending, we need to have documented verifiable income, and that means a W-2, a pay stub, 1099s, tax returns. Cash income is very difficult to document and prove,
Okay.
and we wouldn't be able to do that for conventional or traditional financing. We'd be looking at outside the box options if that were the case. But for most buyers and borrowers, we should be able to document at least a 2-year history.
2 years. Okay.
Yeah, we want to document your work history for 2 years.
Gotcha. So if I'm like a 1099 employee, is that more difficult then? Does that kind of fall into that cash flow situation, or is that...
Yeah, a 1099 buyer or borrower with 1099 income, you're going to have to cough up a little more documentation than
fair.
a W-2
Sure.
employee. So we would, and again, depending on the loan type, we would need to see the last 2 years of tax returns, 1099s, let me give you the worst case scenario.
Sure.
Worst case, the last 2 years of tax returns, 1099s, and usually a year-to-date profit and loss statement.
Okay, so a whole analysis of the business pretty much. That makes sense though.
Yeah.
Thanks for making it through the video. Zack Linder here from Zack Linder and the Zack Pack, powered by Coldwell Banker. Make sure to like, comment, and subscribe. It does support our channel. We really appreciate it. And check out one of these other videos while you're here. Have a great day.